Hello there, Ryan Black, real estate investor and lifestyle architect here. In today's quick investing tip, I want to talk to you about different ways of structuring partnerships when it comes to money. Obviously, there's different ways. Come to the top three most common ways are as a lender, as a partner, or as an investor. And so I just kind of want to go through some of the details of each of those so that you understand the differences, so you can ensure that in your deals, you're making the right choice and protecting yourself from any potential SEC violations, as well as just making sure that you're structuring things correctly. Now, one of the biggest advantages we have in real estate investing is that it is a leveraged investment. That's why it's so powerful. We don't have to use our own money, and usually we don't when we're working on different investment projects. Now, that's great because it allows us to involve other people in the transaction. They get a great return on their money. And then, of course, we, being the brains of the operation, are able to get an even better return because we have nothing out of pocket. So the first one is as a lender, right? When you look at someone who is a lender, that's typically somebody who's going to receive points and interest, or sometimes just interest, but they're simply a debt involvement on the transaction where you have their money for a certain amount of time, and then there is a set interest rate that is being paid on that debt. There's a note, of course, that defines the terms of that debt, as well as some type of security. Typically, with what we do, it would be a trust deed or something of that nature in order to secure that debt against title of the property. So that's kind of the most common traditional way that most people think of when they think of funding real estate purchase is through a lender, through a bank. We use hard lenders, private lenders, and other lending sources outside of the banks as well. But that's kind of your first one that you want to look at is, okay, maybe going the lender route makes the most sense. The second one is going to be with a partnership. Now, if you're doing a partnership with this, you actually have the person being very much involved in the project. They are an equity partner. They have an equity stake or an ownership percentage in the deal of what you're doing. So maybe they're putting in however much money, it doesn't matter, but they're putting in their money and then they're getting a cut of the entity. They become a part owner in the LLC or in the limited partnership or whatever it is that you have set up in order to be able to we participate in the upside as well as participate on the downside, right? So there's more risk, but there's also potential for more reward as a partner. Partners typically are going to be more hands-on in the deal because they want to be and because that's their nature as a partner. So they have more upside, but they also have more liability because they are directly involved on the transaction. And then the third option is that of an investor. Now, when I say investor, it's like, well, I'm an investor, but I'm speaking about an investor as somebody who simply is really, really hands-off and puts their money into a deal. This is something more like maybe syndication or a PPM or something of that nature where you've got people who simply are putting their money on a deal. It's organized by a third party, and the end person, the investor, the person who's put their money, really has no say on anything. They're not involved at all. They don't want to know. They don't know what's going on. They simply know they were offered some type of a return, and that's what they're hoping for. When you get into that realm of raising money from private investors, that is where you can run into some issues with the SEC. So you want to be careful, make sure that you absolutely understand what you're doing and make sure that you're doing it correctly so that you can avoid any of those potential issues of incorrectly raising the capital. Me personally, the way that we have funded most of our deals has been through a combination of lenders and partners. So, debt equity blend, there's different ways of referring to it, but we found that by mixing some straight debt on the deal, as well as having somebody in there who's a partner, who has an equity share, who has some skin in the game, and can also contribute on the deal is a great way of doing it. But there's not necessarily a right or wrong way. Every deal is a little bit different. Just be sure that as you are structuring your deals, not only that you understand that all parties involved understand what type of money structure is going on, but also that it is written down, right? No handshake deals here, that it is written down. And of course, that at the end of the day, all monies are secured on any transaction by a deed of trust or in some other appropriate way. Consult your lawyer if you have any doubts on how to do that correctly, because you do not want to be raising capital that is not secured against a real asset, particularly in real estate investing. So hopefully that was a benefit for you. Thanks for joining me today on today's quick tip. Hope you have a great day. Take care.